What about buy, rehab, move in, refinance?
Yeah.
Don't tell FasterFund.
Sam says that instead of putting a down payment on this, you can finance it the way we talk about financing all of our rental properties or your fix and flips with a hard money lender, a line of credit, private lender.
I talked to an economist yesterday, and he said that Shane Gaynor was there. That he's like, he really doesn't think they're gonna hit interest rates till legitimately they're at 2 or right next to it. Like if it goes down to 3.1, 2.8, they're not gonna hit the Fed's funds. I think that'll affect the Treasury and other things. But the Fed's funds, which is more important for business owners and the economy as opposed to home buyers, the residential, I don't think they're gonna mess with that for a while. Yeah, like probably like a year.
I think there's a lot of different, like at the beginning of the year, I think most people said there's gonna be like 6 different cuts this year, and then that went down after last month's to maybe just 1, people thought, and now it's back up to 2, most people think, and with like a 52% chance starting in September.
Okay, number 1 way to buy real estate using 5% down or less is a conventional loan. Most people think it's that 20%. I've done some research. You can do anywhere from 3 to 5% down. You can put.
I didn't know you could do 3 on conventional. Nice.
So there's the 3% conventional, then there's the 5% like multifamily living kind of thing. So some just restrictions or credibility things for that is you got to have a 620 credit score and 2 years at your job to do the conventional loan. There's no limit of how long you have to live there like some of the other ones. So what do you think about this option? And you want to talk about a few scenarios and as when this would be good for somebody?
Yeah, it'd be good for somebody with a decent job. So if you're limited based off income or credit score, you'll probably go the FHA route, which we'll talk about later. So this is like your typical buyer. Typical type of financing where you use a mortgage broker and they're able to close the loan. They probably sell it on the secondary market.
Freddie,
Government backed more than likely. We call it conventional, but conventional could be any percent down. You could get a conventional loan with 80% down. So it's your probably most standard type of loan out there. I don't know the percentage of house transactions that are financed, what are conventional versus not, but a large percentage of them are conventional loans. So when you hear about buying a home and you're going to get approved and you have a decent job and decent credit, this is the type of loan you're going to get. Yeah,
for sure. So this is one that I hadn't really heard much about, the 3%. Like we mentioned a little bit earlier, the 5% is something that was newer. Is that exclusively for multis?
No.
2, 3, 4 units?
Nope, you can do.
You just got to live in it. So
you can do 5% down. It's pretty typical, I would say.
The cons of that, Walls?
Of putting down
conventional
5%.
Mortgage makes up 71% of all mortgages. Luke, you were right. Good job.
Pros and cons of putting
5% down on a conventional loan as opposed to 20%.
Yeah, well, current homeowners are the people in the catbird seat. They have equity.
Stop using that. No one knows what that means.
And we looked it up last time. It's a thing, Sam. It's a thing. It's my thing.
Yes.
Let me have it.
Take it. I don't want it.
But the people who currently own a house and have let's say the past 2 years plus have equity and have a good interest rate, better than what you could get in today's market.
Okay.
If you're selling that house to move into another house, chances are you're able to put down a bigger down payment because you've had equity growth through appreciation and debt pay down. You can take that tax-free from your sale and put it down, a larger down payment down on your next house to lower your payment. So lower down payment is awesome for first-time home buyers in particular because it's just hard to save up savings to get down 20% of a $300,000 house.
60 grand.
That's 60 grand. It takes a long time to save 60 grand.
And a $300,000 house is not a ton in a lot of markets.
It is.
It's not even the national average house.
It is, right.
So the national average house, you're going to have to come up, it's like 400 right now.
Yeah.
80 grand for the national average house.
That's a big chunk of money to, save whatever.
Without equity,
Yeah, without equity, it's really hard to get there. So first-time home buyers, I think it's a great option for the lower percentage down just to get in the game and start building that equity.
So that was the first one. Why don't you introduce option dose?
FHA, which is pretty sure that's how I bought my first house.
You don't know?
I don't know.
Okay.
Man, it's been a while.
Okay.
But bought a 3.5% down. I just got a job, so that's probably one of the reasons why I went FHA. Didn't have much credit at the time. I don't think it was bad, just didn't have like a huge history of credit. So I went FHA, and it's for people with, maybe not in your current job for very long, or maybe a little lower income, that they have a little different parameters that you can get approved for in debt to income, and then also lower credit scores are a good option for FHA.
580 credit score. I think I bought my second house with an FHA. I don't know that either. I made fun of you, but because I think, remember, you probably don't remember this, but I went in college. I had like a doctor's appointment, and was on my parents' insurance, and they paid it, but somehow it didn't show as paid, so I didn't know my credit score got dinged down to like 600 or something without me knowing. So I think I had to do that.
Yeah,
so
that's probably why.
Yep.
So
FHA. So it's a good option, lower down payment, but you know, there are more rules and regulations, and FHA gets involved a little bit more with inspections and things like that, and appraisals.
Yep.
So a few more hoops to jump through, which happens when the government gets involved.
Yep. Matt with the 203K way talked about getting into a house that needs some work, financing 97.5%. Wait. 96.5% of the purchase price and rehab funds.
Boom!
If you use the FHA 203K loan.
So the interesting thing about this is, you can get the rehab finance if you use approved FHA contractors. So the interesting thing about this one, Lucas, is your PMI is going to be much less. You're probably to pay it much less, because if you buy it distressed, and you're using somebody else's money, by the time you close on it, you're going to have way more. You should have way more than 3.5% equity.
For sure.
Hopefully 10, maybe even 20.
Even if you don't do it right, you're going to have more than that.
Yeah.
And the good news is, if you build in that equity by doing the rehab, whether it's 5, 10, 15%, let's say, something, you're much closer to that 20% equity that you need to at some point get your credit score up and be able to refinance and get rid of that PMI.
How do you think they calculate that equity? Do you think when they think they have it, or do you think they do like a mat, like every year they do an appraisal to see, you know what I mean? Because somebody that did an FHA loan in 2000,
I think you have to refinance.
Do you?
I think so. I don't think they just drop it.
Well, no, I would. Yeah, but like in 2020, somebody did an FHA loan. By 2022, I guarantee you they had 20% because the market went up so much, and every market went up 10, 15, 20%.
Yeah, that's a great point. I don't know if you bump your lender and ask them to do an appraisal, or just refinance it. And obviously, at that point, you have an appraised value that you can definitely get the 80%.
Because either way, you did FHA or FHA 203K.
Or conventional.
Yeah, but you're gonna get that. You're gonna in most years it goes up 4 to 5%. So just within 3 or 4 years you should have it. But definitely back.
I'm not sure. I've never stayed in a house long enough to.
Yeah,
I did it with my.
You're a mover and a groover.
I did it with our new build because we only put 15% down. And then we refinanced after a nice year of appreciation to get rid of that.
Yeah, because you got good equity in your house. Yeah. Number 4 is a VA loan. Now, obviously, or not, maybe not obviously, it's this is a veteran loan. You have to be a veteran to get this, but it's got some really cool features. 0% down. There's no minimum credit. You have to have a job for 2 years, and you can reuse one, but you have to live there for at least a year, so you can continue to reuse it.
You just can't have 2 VA loans out at one time.
Yep.
Yeah, that is beautiful.
Yeah, it's a cool. I mean, you're in the military, so you should have some perks. I think this should be one of them. So I 100% agree with this one. So, and I love the no minimum credit. So this is a cool one. This doesn't apply to everybody.
Think about it. You just sign up and close, pay some closing costs probably, and then just start making payments. You don't have to bring a giant chunk of money to the table.
Yeah.
Which you're 100% financed. There's some risk with that if the market changes or whatever. But in general, prices go up.
Get it?
And debt goes down.
Get it, general?
I do.
Get it? Like a military general?
Yeah.
Okay. That was pretty good. Don't overdo that. Luke gets mad. All right, number 5, USDA loan. This is how I bought my very first house. Did you know that?
Yeah, because you were kind of out in the sticks there.
I guess. Not really.
Oh,
Lake St. Louis.
I was thinking of your second house. You bought your Lake St. Louis.
It was
one?
USDA.
Do you think it would qualify now?
Probably not.
Yeah.
No. So USDA loan is 0% down, 620 credit score. The only issue is you have to be on USDA approved land, which most people think is like out in the complete boonies. U.S. Department of Agriculture, USDA. It's not. Like where I was out in Lake St. Louis, Missouri, which is like normal like suburb. but I guess the land had not been rezoned or reapproved, whatever, because eventually at some point it was out in the boonies, but it wasn't when it was in the middle of a neighborhood. And
but right now there's probably 5,000 houses around there.
And when I bought it, there's probably 1,000 houses
more.
around there, maybe 2. Like, it was not a normal what you would think of.
It's been a while though, man. A lot has happened in the last
that was 2000
years.
It was 2011.
Wow, 13 years ago. I still dread that by that house because I can cut through to my neighborhood.
You see my deck I put on my fence?
Yep, I see that. I know which one it is.
Yep. So we anyways, that was during 2011 we built and put 0% down, so that was pretty wild.
So you built it at 0% down. That's sick.
Thanks for watching. We appreciate it. Make sure to hit that like button, comment with something you learned, and make sure to subscribe to this channel. We give away more free advice on how to create wealth based on things we actually do every single day than any other channel on YouTube. Make sure to share this with a friend because our mission is to inspire you to think differently about freedom.